37 of the House of Commons Standing Committee on Finance, pursuant to Standing Order 1082. The committee is meeting to study the report of the Bank of Canada on monetary policy and the economic and fiscal outlook. Today's meeting is taking place in a hybrid format pursuant to the House Order January 25, 2021, and therefore members are attending in person in the room and remotely using the Zoom application. The proceedings will be made available via the House of Commons website, and the website, as most everyone knows now, will show the person speaking rather than the entirety of the committee. And based on the experience in the House, it's just as well not to take a screenshot of the proceedings. So with that, we will welcome our first guest. And before I get to the Governor of the Bank of Canada, to give you a heads up on the question list on the first 6-minute round, the first one will be up will be Mr. Polyev, followed by a split with Ms. Julian Annie. Okay, turning then to the Governor of the Bank of Canada, Mr. Macklem, welcome. You've been here before. Pleasure to see you again. The floor is yours.
Well, thank you, Chair. I hope you can hear me well. Good afternoon to you and all the committee members, and I'm very pleased to be back with you to discuss our monetary policy report, our economic outlook, and the actions we're taking to support the recovery. If I had to sum up the message for you in 3 words, they would be progress, time, and commitment. Premièrement, l'économie fait de bons progrès.
First, the economy is making good progress. Canadian households and businesses have shown impressive resilience to the pandemic. The economy is doing better than we expected. And with more and more Canadians getting vaccinated, we anticipate better times ahead. Reflecting these developments, last week we revised up our outlook for the Canadian economy. But secondly, a complete recovery will still take some time. The third wave of the virus is a new setback. It is straining healthcare systems in many regions and again hitting sectors where physical distancing is difficult. Important parts of the economy remain very weak, and too many Canadians are still unemployed.
Third, the bank remains steadfast in our commitment to support Canadian households and businesses through the full length of the recovery. For working Canadians, a complete recovery means a healthy job market with good opportunities. And that includes low-wage workers, women, and young people who have been hit hardest by this pandemic. A complete recovery means companies have confidence that the pandemic is over and they're investing to seize new opportunities. And for households and businesses, a complete recovery means they can count on inflation being sustainably at our 2% target. Let me expand on these themes. At the time of our last NPR in January, Canada was facing a second wave of the pandemic, and we expected the economy to contract modestly in the first quarter of 2021. As it turns out, it now looks like the economy grew strongly in the first quarter. This is partly because the global economy is stronger, particularly in the US. But the most important factor is the resilience and adaptability of Canadian households and businesses. They have found new ways to shop, serve customers, and work remotely. As a result, lockdowns through the second wave had much less economic impact than they did through the first wave. And as restrictions were eased, the economy bounced back with substantial job gains in February and March. Housing construction and resales have been particularly strong, rising to historic highs. This is being driven by a desire for more living space, low mortgage rates, and limited supply. But we are seeing signs of extrapolative expectations in some housing markets, and there are risks that some households may overstretch financially. We'll continue to watch this closely. Comme la vaccination avance,
with vaccinations progressing, we are expecting strong consumer-led growth in the second half of this year. Fiscal stimulus from the federal and provincial governments will also make an important contribution to growth. Strong foreign demand and higher commodity prices are expected to drive a solid rebound in exports and business investment, leading to a more broad-based recovery. We now project that the economy will grow by around 6.5% this year, and then growth will slow down slightly to about 3.75% in 2022 and 3.25% in 2023.
Hopeful that there will be less labor market scarring and less lost capacity than earlier feared. And we've revised up our estimate of the economy's potential output. But I do want to emphasize that considerable uncertainty surrounds our estimate of potential. As the recovery continues, we will be paying attention to a broad spectrum of indicators of slack, including a range of labor market indicators. La semaine passée, nous avons vu que l'inflation.
Last week, we saw that inflation rose slightly above our 2% target in March. This increase was expected. Indeed, over the next couple of months, we anticipate inflation will rise further to around the top of our 1 to 3% inflation control target range. This largely reflects base year effects combined with the recent rise in gasoline prices. Governing Council is looking through these temporary increases in inflation because we expect the ongoing excess supply in the economy to pull inflation back down. Inflation should return to 2% on a sustained basis as slack is absorbed in the second half of 2022.
The improved economic outlook and the considerable slack that remains, Governing Council judged last week that the economy still needs extraordinary monetary policy support. We remain committed to holding the policy interest rate at the effective lower bound until economic slack is absorbed, so that the 2% inflation target is sustainably achieved. As I just mentioned, based on our latest projection, this is expected to happen sometime in the second half of 2022, although this timing is unusually uncertain given the difficulties in assessing the economy's supply capacity. Our forward guidance on the policy rate continues to be reinforced and supplemented by the bank's quantitative easing or QE program. Effective this week, we adjusted our weekly purchases of Government Canada bonds to a target of $3 billion, down from the previous minimum of $4 billion. This adjustment reflects the progress we've already seen towards economic recovery. Before I turn to your questions, let me say a few words about our QE program and its impact on our balance sheet, as I know this is a topic of interest of many committee members. Around this time last year, the bank launched a number of extraordinary programs, 11 in all, to help restore functioning in financial markets and keep credit flowing. These programs worked, and with markets now functioning well, we have wound down or announced the termination of all but one of our extraordinary programs. The one remaining is our QE program. It is still providing needed monetary stimulus by lowering borrowing costs for households and businesses across the yield curve. With other programs winding down and QE continuing, the size and composition of our balance sheet has shifted in the past several months. The size of our balance sheet peaked back in February at about $575 billion. It has since decreased to about $475 billion. This decline reflects the maturing of some of the shorter term assets and the termination of most of our extraordinary programs. We continue to buy Government of Canada bonds to provide stimulus in pursuit of our inflation objective. The bank currently holds about $354 billion of Government of Canada bonds, comprising more than 70% of the assets on our balance sheet. This is up from 55% last January. I provided you with a chart that shows the evolution of our balance sheet and a table that provides more detail on the maturity composition of our holdings. And as you can see from the table, the Bank of Canada currently holds just over 40% of the outstanding stock of Government of Canada bonds. Across the maturity spectrum of nominal bonds, our ownership ranges from 48% at 5-year bonds to 36% at 10-year bonds. And we routinely make available high demand bonds through our securities lending program, and this helps promote the smooth functioning of Canada's government bond market. Now, I've given you a lot of numbers. The message I want to leave with you is that our purchases have provided a lot of stimulus to the economy. With the progress toward economic recovery that we've already seen, we adjusted the amount of incremental stimulus we're adding each week with our purchases. Looking ahead, further adjustments to the pace of net purchases will be guided by our ongoing assessment of the strength and durability of the recovery. If the recovery evolves in line or stronger than in our latest economic projection, the economy won't need as much QE stimulus over time. Further adjustments to our QE program will be gradual, and we will be deliberate in our assessment of incoming data and our communication of our analysis. We remain committed to providing the appropriate degree of monetary stimulus to support the economy and achieve our inflation objective. And with that, Mr. Chairman, let me stop and address the committee's questions.
Thank you very much, Governor, for the starting with the 6-minute round, Mr. Poilievre, followed by Ms. Zerowitz. Pierre, floor is yours.
Governor, I was fascinated to hear you say that the purpose of your quantitative easing, that is these mass purchases of government bonds, is to help households and businesses. And you didn't mention that it was designed to help governments spend borrowed money. On April 19th, the finance minister introduced a budget which proposed a deficit of $154 billion. That works out to $3 billion a week. That's how many bonds, how many dollar values worth of bonds the government will have to sell. How much are you proposing to buy every single week? Just the number, please.
Right now, we're buying $3 billion a week.
Well, what a coincidence that is. The government is going to be selling $3 billion worth of bonds per week, and you're going to be buying $3 billion a week. Mr. Chairman, it is a miracle. What a coincidence that those two numbers line up so closely. And you announced that $3 billion number exactly 2 days after the minister laid out the same number in her budget. Is that a pure coincidence?
What I can tell you is that our purchases of government bonds are guided by our inflation target. We have seen considerable progress in the recovery. We don't need as much quantitative easing, and that's what guided our decision to reduce the amount of purchases each week.
So on an annual basis, the government will borrow a net $154 billion, and you will provide a net $156 billion. So there's an extra $2 billion. Keep the change, Mr. Government. That has to be a coincidence. But you're saying, no, the purpose of this is the inflation target. Well, 3 of your 4 measures of inflation are now above the target, which would presumably mean you would pull back. And even the Financial Post said central banks and government out of touch with Main Street when it comes to rising costs of living. The Canada's food price report shows that food costs increased almost 3% last year, with an expected increase of almost 7% in meat, almost 6% in bakery, and almost 7% in vegetables. Not to mention, housing prices are up more than a third in just over a year. I think we have enough inflation, Mr. Governor. Why do you keep printing money?
Mr. Governor.
It's really quite straightforward. We're in an economy that still has major parts that are very weak. There are still far too many Canadians unemployed. there are large parts of the economy that remain well below their capacity. That is all putting downward pressure on inflation. And to give you a picture in terms of actual Canadians, we're still 300,000 jobs below where we were pre-pandemic level. And over the more than year, new Canadians, Canadian students have graduated, Canadians have entered the labor force. It's about 500 below the 500,000 below previous pandemic level. That is putting downward pressure on inflation. And we are committed to supporting the recovery, getting Canadians back to work, and that is critical to get inflation sustainably at our 2% target. And that is what is guiding our policy decisions.
Mr. Governor, I have no doubt that that unemployment is high. The job market is terrible, but inflation is high too. You said you admitted today for the first time that you're going to bump up on 3% inflation, something that you told us and your predecessor told us was not possible when you first testified about this quantitative easing program only a year ago. And the people you claim to be helping, low-wage workers, women and young people, they're the victims of inflation. You have admitted, sir, at this committee that the poor and the young and the dispossessed are disproportionately harmed by inflation because they deal more in cash and because they don't own assets that inflate. So why are you once again pumping billions of dollars into the system to inflate the things that the rich own, but that the poor have to buy, thus widening the gap between rich and poor?
Let me clarify a couple of points. First of all, we are committed to achieving our 2% inflation target. An important, and that, as you highlighted, is important particularly to low-income Canadians because they tend to hold more cash than other Canadians, and so they suffer more from inflation. So it is really important, and we have a very strong record over the last 30 years of achieving our 2% inflation target on average, and we absolutely intend to continue that. Secondly, as I've highlighted, and as you mentioned, there are many unemployed Canadians. There are far too many Canadians out of work.
With respect, Governor, my question.
The best thing we can do to help those Canadians is to get them back to work.
Last question, Pierre.
Printing cash won't do that. Your method was tried in the early 80s. It led to stagflation, high unemployment, and high inflation. You claimed that this money printing was about restoring functioning of markets, but credit and capital markets are flush with cash more than ever before. You claim it's about getting to the 2% target. We're already over the 2% target. The only thing that makes any sense is that you're printing about exactly the same amount of money as this government needs to borrow. But by funding the government with printed money, you're making housing unaffordable for young people in my riding, and you're making food and other essentials unaffordable for seniors and the poor. And this policy has to come to Mr. Chair. Will the governor commit that he'll stop printing money and giving it to the government once we hit 3% inflation? Yes or no?
With respect, our policies are working. The economy, this is a bad third wave, and we need to get through that. But we have seen impressive resilience in this economy, and that has a lot to do with the adaptability and resilience of Canadians, but it also has a lot to do with the fiscal and monetary supports that have been provided. This economy still has some ways to go before we hit that complete recovery, and what we're committed to do is to support the economy through the full length of the recovery to get inflation sustainably back on target.
Thank you both for a little over. Turning then to Ms. Zerowitz, who will split her time with Ms. Petrakis. Julie?
Thank you so much, Mr. Chair, and I want to thank the governor for being here. Thank you so much for making time today. Thank you so much for your service to our nation during these unprecedented times. I'm going to continue the conversation around our labor market. As you mentioned, it has been remarkably resilient. You've also mentioned that despite the fact that we've actually had substantial job growth over the last couple of months, it still remains very difficult for many Canadians, particularly low-wage workers, particularly young people, particularly women. Our federal budget 2021 has invested significantly in these three key groups. Can you talk to us about how focusing and investing in these groups is good economic policy?
Well, before I go any further, let me just underline. I'm here as the Governor of the Bank of Canada to talk about our outlook, monetary policy, and the actions we're taking. It's not my role to comment on the government's budget and the individual measures. What I am prepared to talk about are the implications of fiscal policy for monetary policy. And we have built into, we take federal and provincial budgets and we build those into our own projections. And certainly over the last year through this pandemic, the fiscal supports from the federal government, from provincial governments have been instrumental in supporting Canadians. And as I underlined in my previous answer, while we still have a considerable ways to go, this combination of fiscal and monetary policy is working. There are a range of measures in the budget. We have included, the budget came out obviously 2 days before our monetary policy report, so we don't have every detail in there. But from a macro perspective, we have included the essential features of the federal budget that is built into our projections, and so the support that is provided in the budget is built into those projections.
Thank you. And then I'll ask one more question before I turn it over to my colleague. What would you say at this point are the key risks to the Bank of Canada's economic projections, and how do they compare to those of the IMF and OECD, which are actually quite favorable?
Look, the biggest risk is clearly the evolution of the pandemic itself. This third wave, it is straining our healthcare systems. It is requiring new public health measures, new containment measures. Unfortunately, that's putting some of the same people who have been hardest hit by this pandemic out of work again, or it's delaying their return to work. The good news is vaccines are rolling out. I got my vaccination a couple of weeks ago. And Canadian, we're roughly about 30% of Canadians now have a first shot. But we've seen this virus is very unpredictable. There are new variants out there. That is certainly the biggest risk to the projection. There are when you look at our projection, there are some upside risks as well as some downside risks. Canadians have accumulated a substantial amount of excess savings through this pandemic, which I can go into detail on. But we're assuming, based on what Canadians have told us by and large, that we expect Canadians to reduce their savings rate to where it was pre-pandemic. So begin consuming again at the same sort of rate that they did before. But we are assuming that the extra accumulated savings that they've built up, that they use that to pay down debt or invest or buy houses. So they could end up dipping into more of that savings, and consumption could be even stronger than our forecast. So there are upside risks and downside risks.
Okay, we'll have to move on
Thank you
to
so much.
Ms. Koutrakis. You got about 2 minutes, Annie.
Thank you, Mr. Chair, and welcome, Governor Macklem. It's nice to see you again at Finance Committee. Governor, in your opinion, are we on the right fiscal and monetary path? And how can you assure the Canadians that the Bank of Canada can prevent a negative outcome of inflation and high interest rates?
Okay, well, there's really two questions there. On the first one, as I said, I don't really see it as my role to opine on fiscal policy. What I will say in terms of the budget, it lays out a track for spending. And underlying the budget is a forecast that is sort of an average of private sector forecasts. That forecast is not that different from the forecast that we published last week. We are actually a little bit stronger Our forecast is a bit stronger this year, which I think largely reflects the fact that the data coming out in the last month has been fairly positive. But next year, the year after, the forecasts are fairly similar. So these are forecasts, as I just highlighted. There are risks around them, but it's a reasonable planning basis. In terms of your own assessment of, as parliamentarians, of the fiscal track, I know you're speaking to the parliamentary budget officer. I think you want to look at international comparisons. We were fortunate to go into this crisis with the lowest net debt to GDP ratio in Canada, and we retain that position. The other thing you can do is you can look at credit rating agencies. S&P yesterday reaffirmed Canada's AAA rating. Different agencies have different assessments, but those are, I think, all good resources at your disposal. With respect to the Bank of Canada, which is what I really want to talk about, what can we do to assure Canadians that we will control inflation? We have a very clear mandate. We have a strong record now of 30 years of inflation targeting, and we have consistently realized that objective. I can tell you, as governor, I am committed to getting the economy back to its potential output with inflation sustainably at 2%. And as I said, we still have some ways to go, but we're closer than we were last time I was in front of this committee.
Okay, thank you all three very much. Turning to Mr. St. Marie, followed by Mr. Julian. 6 minutes, Gabriel.
Oui, merci Wayne. Alors, bonjour.
Thank you, Wayne. Good afternoon, Governor. I would like to quote an article from Mr. Rubini that is translated here into French, and I would like your reaction to it. It says, central banks are looking at budgets, and they look at them as an application of modern theories. If you look at the high numbers right now, the GDP is very high in many developed countries. There's a combination of low interest rates on the short term and medium term that could maintain some sustainability of that. If we had some major measures, there could be a collapse of the system. And he concludes that the central banks have, in fact, lost their independence. I was wondering what your reaction to that would be. My reaction to that article is that I am very confident in our independence. As I mentioned already, our policy is based on our inflation target. That is our guiding light. What we have already shown is that as a situation evolves, we adjust and we change our policies. When we started the quantitative easing program, we were purchasing $5 billion worth of bonds every week. We dropped that amount to $4 billion the first time when we changed our direction. And last week, we reduced it from a minimum of $4 billion per week to reach our objective of $3 billion per week. That reflects the progress that we have already seen during this crisis. And we will continue to make adjustments and respond in the appropriate manner to achieve our inflation target. I have no concerns regarding our independence. Yes, these are extraordinary tools that we are using, and we are in extraordinary circumstances, and that's why we need extraordinary policies. That said, I think we have shown that we will make adjustments to make sure the economy gets what it needs. Thank you for your answer. It's also nice of you to answer in French. I can see that you're originally from Montreal. I would also like to hear your reaction to Ben Bernanke's analysis. Perhaps I'm not going to quote him very well, but he says that if there is an excess in saving, it could lead to a drop in interest rates and low inflation. Do you agree with his comments? What is your reaction to that article? Ben Bernanke, when he was a professor, and in fact he is professor again, when he taught at Princeton, he published a number of important articles on the global savings glut. So yes, there's too much savings in the world and not enough investment projects. That is one factor that we have seen recently. There's a balanced interest rate that has been lower over time as a result. There are a number of factors that come into play, but one is that with the aging of the population in many countries, there is a savings glut versus the demand for investment. And when there are more savings and fewer expenditures, that is the result. It's important for our monetary policy because it no doubt implies that we are going to reach our floors for the base rate more often. And in situations like the one we're in right now, we'll have to use other tools, such as quantitative easing, so that the other indicators fall into line. Yes, I think it's a very important thing to bear in mind. Now, barring another major crisis, would you consider going into negative territory? Well, negative interest rates is a tool at our disposal, but we don't think we're going to go down that road. At least that is what I predict. I don't think we'll have to go that route. But if the situation changes considerably and we find ourselves in an extreme situation, it is a tool that we can invoke. But I would say that the bar is quite high for that.
Une chose que je peux juste ajouter, nous avons
to help us with a renewal of the inflation framework and our inflation targets, we did carry out a survey among Canadians. It was very interesting to know the perspectives of Canadians. Obviously, there were differences of opinion, but what we did learn was that Canadians greatly support the quantitative easing tool, but they really don't like the idea of negative interest rates. Thank you very much. I imagine that I have used up all my time, Mr. Chairman. Is that correct? Wayne, I'm sorry, your mic is on mute.
Julie and the other three get 7 minutes each, so you'll have 7 too, and then we'll go to Mr. Fast.
Thanks very much, Mr. Chair. Thank you, Governor Macklem, for being here today, and your availability over the course of this pandemic has been very important, and we thank you for that. I have a couple of questions around both the Bank of Canada's mandate, but also you mentioned earlier the implications on monetary policy of fiscal policy. Now, we know that it really is a tale of two countries. During this pandemic, we have seen Canada's billionaires increase their wealth by $78 billion so far. seen massive profiteering in certain sectors. And we have seen some Canadians, wealthier Canadians, being able to put away savings, as you mentioned. But Canada continues to have the worst level of family debt in the G7 and the lowest saving rate in the G7. And at the same time, over 50% of Canadians struggle even to put food on the table. The most recent figures, as you know, half of Canadians are within $200 of insolvency on any given month. And that has been exacerbated by this pandemic. So what we see is a growing chasm between a smaller number of Canadians that are increasingly wealthy and a large mass of Canadians that are absolutely struggling to make ends meet. And yet we have a government that has practiced failed fiscal policy, hasn't put in place a wealth tax like other countries, hasn't put into place a pandemic's profits tax, even though during the Second World War we had that in place and it allowed us to fight Nazism and fascism. And after the war, put in place all of the infrastructure contributed in health and education and transport and housing that allowed us to build a prosperous economy. So my question is twofold. First, the implications on monetary policy of what is a failed fiscal policy, where the wealthiest citizens are simply not paying anywhere remotely their fair share of taxes. And then secondly, in terms of the consultations that the Bank of Canada has done, increasingly people have been raising in the course of those consultations the impacts of targeting full employment at the same time as there is inflation targeting. In other words, having a dual mandate for the Bank of Canada on monetary policy. And I recognize that monetary policy can't solve all the problems of failed fiscal policy, but increasingly, as you note, with 500,000 people that haven't been able to return to their jobs, and knowing from the past that it takes up to 10 years for the economy to recover for lower income people, as we saw during the Spanish flu pandemic. What do you think the implications are for having a mandate that actually takes into consideration full employment?
Well, let me answer that in two parts. First of all, I do want to assure you, Peter, that employment is an important element of our framework. You can't keep inflation sustainably at 2% if you have a large number of unemployed people, because the economy is missing income. And that means there'll be downward pressure on inflation. At the same time, having inflation well anchored at 2%, the lesson from history is that that reduces these sort of inflationary boom bust cycles that we had, particularly in the 1970s, which you get big buildups of inflation, then you have to have a big recession that puts a lot of people out of work. So these two things, stable inflation stabilizes the labor market. You get less cyclical unemployment. At the same time, full employment, a complete recovery is critical to keeping inflation sustainably at 2. So labor market is, the labor market is an integral part, and you've probably no doubt seen, particularly given, as you highlighted, the very unequal impacts this pandemic is having on the labor market. We've been talking a lot about the labor market. We've been looking at a broad range of labor market indicators. We are looking at because there are some big divides, we are looking at labor markets at a more granular level. You referenced what we heard from Canadians, and it was very interesting what we heard from Canadians with respect to our inflation target regime. Overall, our flexible inflation targeting regime was the sort of preferred alternative of Canadians. But as you suggested, many Canadians did highlight that they want to make sure that employment and jobs are a central part of our framework. And some Canadians suggested that a dual mandate might be a way to do that. I will say there was quite a bit of diversity around that view, though. Some Canadians thought a dual mandate would be a good idea. Others were concerned that, unlike inflation, the Bank of Canada ultimately can control inflation. We don't have as direct control of labor markets, and so that might not be a good idea to have a dual target. Anyways, but the main message from Canadians was that this should be an important part of the considerations. And I found that, I think we all found that feedback very interesting.
A fairly quick question, Peter.
Well, just to follow up, as you mentioned earlier, you are prepared to comment on implications on monetary policy of fiscal policy. Many people are saying the government's fiscal policy has failed because of this creation of a very profoundly unfair tax regime. Do you feel that that has implications for monetary policy? Understanding that monetary policy can't solve a bad fiscal policy, but understanding that there are implications of bad fiscal policy on monetary policy.
Well, what I would highlight, as I said before, is fiscal policy, federal and provincial, has played an extremely important role in helping Canadians get through this pandemic. Indeed, I think fiscal policy has played a leading role. Monetary policy has played an important role. But monetary policy does not have the ability to target certain groups. It's a broad macro tool. Fiscal policy does have the ability to target certain groups, and the supports that they've given, particularly the most vulnerable Canadians that have lost their jobs, have been very important to supporting supporting Canadians and helping us through this recovery. Yeah, I think I'll leave it there.
Okay, and we'll leave it there too. That's 7 minutes for all four. Mr. Fast, followed by Mr. Fraser. We're into 5-minute rounds. Ed?
Well, thank you, Mr. Macklem, for appearing at committee. I believe it's the first time I've had a chance to speak with you here. I want to return to the issue of quantitative easing, and I'm not going to tell you how to do your job. But I did want to ask you, you've signaled that you'll be winding down your QE program at some point in time. Did you suggest that might be the second half of 2022, or did I get you wrong?
No, it is a bit complicated. So the second half of 2022 refers to, based on our forecast, when we expect slack is likely to be absorbed. And what we have indicated with respect to our forward guidance for our policy interest rate is that we would hold the policy interest rate at its current level of 0.25% until slack is absorbed. Okay. So that forward guidance is really more about the policy rate, and I would underline that this is a commitment not to raise it. It doesn't mean we will automatically raise it when we get there. We'll have to see what the economy needs when we get there. Yeah, but we're committing to hold it there. With respect to our quantitative easing program, we
actually. Yep. I had a specific question on that, so because my time is limited. So as you wind down, obviously the government will continue to have to borrow at, say, an average of $3 billion a week, as my colleague Mr. Poilievre suggested. Am I correct?
Oh, whether that's in the budget? Yeah.
No, not whether it's in the budget. Given the size of the deficit that's projected for this year, the government's going to have to borrow money to make up that deficit.
Correct.
As you wind down your QA program, I'm assuming that the government is going to have to go to the market.
Well, the government is going to the market. The government auctions this debt into the market. We buy this. We buy what we're buying through quantitative easing in the secondary market.
Okay, so you're buying it at market interest rates. Is that correct?
Correct. It is bought in a competitive reverse auction process.
All right. Can I also ask you about the stimulus program, because you've got $100 billion plus of so-called stimulus that is being injected, but you also have influences from the United States. You've got a very large infrastructure program there, a large stimulus program. You yourself have referenced that there are record household savings sitting on the sidelines right now. What impact, if any, will these different elements have on the inflationary pressures that the bank is going to have to deal with?
So with respect to the U.S. recovery, that is one reason why our outlook is stronger. The U.S. Combination of rapid rollout of vaccines and large fiscal stimulus package, the U.S. economy is growing strongly, and that will help. That will certainly help our exports, and that is reflected in our outlook, and that that's an important element of our projection. We expect that our the main reason for the recovery in our projection is we're expecting a strong consumption-led recovery. As we can get back to more normal activities, we think consumers, how Canadians are going to go spend money, and that'll lead the recovery. The U.S. element is helpful because it will broaden the recovery. We'll have consumption, we'll get more exports, that should lead to more investment. That all means you get a more broad-based recovery, and that is like, a more broad-based recovery is more sustainable, and that's something we'll certainly be evaluating going forward and assessing how much monetary policy stimulus we would need.
Actually, my question was directly on inflationary pressures. This massive stimulus from different directions, do you expect that's going to stoke some inflationary fires?
Well, you can see our projection for inflation in the outlook that we published, and the strength of the U.S. We revised up our outlook for the U.S. economy substantially. We've built in the fiscal stimulus at a macro level that's in the budget. And what you see is that inflation is rising right now temporarily to about 3%. That really reflects some special factors. I can get into them, but it's more to do with what happened a year ago when a number of prices plummeted. And a year later, that creates a temporary blip inflation. But as I highlighted, we still have high unemployment in this country. There's still many people out of work. That's putting downward pressure on inflation. But as we do expect this slack to be absorbed, which is a good thing. And as that slack is absorbed, we should get inflation sustainably back to 2. And what you can see is that inflation goes up to 3, it comes back slightly below 2, and then goes slightly above 2 and settles into 2. So in our projection, it's staying pretty close to 2. And we factored those things in.
Mr.
Okay,
Chair, how much time do I have?
You have a 0 time left.
Okay.
I'm sorry. We'll go to Mr. Fraser, and then we'll go one question from Mr. St. Marie and one from Mr. Julian. Mr. Fraser, 5 minutes.
Governor Malcolm, thank you so much for being here. I'll jump right to my questions in the interest of time. During your testimony, you indicated that the mix of fiscal and monetary supports that have been provided to the economy have largely been effective. You described the downward pressure on the economy that could lead to deflation and potentially job losses had those supports not been there. I'm curious if you've done any analysis or if you have any views on what the premature withdrawal of significant fiscal and monetary supports would have in terms of the impact on real people and businesses across the Canadian economy.
Well, what we've seen in past recoveries and coming out of 08, 09, I think would be the most current example, is that if you withdraw stimulus prematurely, the recovery stalls, and then you've got to put in some new stimulus to get it back, and you lose the momentum, and you have to restart it. So that is certainly a lesson that we've all taken to heart. There are other lessons from history. I think if you go back to the late 60s and the early 70s, where there wasn't enough attention paid to inflation, and the result of that was we built up a big head of steam on inflation, and then it was very difficult, it was very costly to drive that out of the system. So I think the lesson from history is that you do want to you do want to support the recovery through its full length. That will require some patience, but you also need to react to the data as you see it coming in and adjust accordingly so that you don't overheat the economy.
So I've got two quick questions to follow up then, picking up where you left off. You mentioned the indicators that you need to pay attention to. What kind of economic conditions would you need to be observing before you would have fears that inflation is going to be a serious problem for the Canadian economy?
Well, let me say a word about our forward guidance that we've put out and how it works. So let's just remember where we were a year ago. A year ago, the economy was basically going over a cliff. Inflation was extremely low. It was actually negative. Our main concern, our biggest fear was deflation, which would have been very damaging. And against that background, we used a number of extraordinary tools. One of those is exceptional forward guidance. And we've indicated that we will hold the policy rate at the 0.25% until slack is absorbed. We take that commitment seriously. It was done very deliberately to prevent a much worse crisis. And as I said, we still have some way to go, but it is working. What that means going forward is that given that we're going to hold it at the effective lower bound until slack is absorbed, we probably will get some excess demand, because as we move from excess supply, we'll probably get a little bit of excess demand, and you can see that in the forecast that we put out. And with that, you'll probably get inflation going a little bit over the 2% target. We have a control band of 1 to 3%, and we're prepared to use it. That's part of a flexible inflation targeting regime. What you would look for, as we get there, it'll be very important to assess pressures in labor markets. It'll be very important to assess pressures on physical capacity of companies. And it'll be very important to look at the information in inflation itself. If it's coming in above what we think it should be, that's an indication that, well, maybe things are tighter than we thought. On the other hand, if it's coming in a little less than we thought it would be, that's a suggestion that, well, maybe there's a bit of more room for the economy to grow without inflationary pressures. And those are the kinds of assessments we'll be making. We're still some ways. I look forward to that day when we get to do those assessments, but that is still some ways off. We got to get there.
I very much look forward to those times as well. Final question. I've only got about 1 minute left, and it segues perfectly from your description of the 1 to 3% sort of band that you're aiming for. One of my committee colleagues, Mr. Poilievre, has tweeted out just several minutes ago. Now, central bank governor admits to Finance Committee that inflation will be well above 2% target for the next 2 months, after saying for months that would not happen. That is not my view of your testimony today whatsoever. Would you care to offer any clarifying remarks so your testimony is not misrepresented?
Well, we've actually been saying for some time that if you look back, we've been saying for some time that inflation would go above the 2% target for a period on roughly the first anniversary of the pandemic. And just to elaborate on, so you'll remember a year ago, economy went over a cliff, a number of prices, oil prices actually went negative, gasoline prices were incredibly low, and prices of things that were deeply affected by the pandemic, airfares, for example, airlines were seriously constrained airfares, a number of prices plummeted. So we measure inflation as the 12-month rate of change of the CPI. So we're looking today, right now in April, we have the March number, 2.2. That's relative to March of last year. And when prices are highly depressed a year ago, you get a temporary blip up in inflation. That's a temporary effect due to these technical base year effects. The underlying pressure on inflation from the economy is still downward because there is considerable unused capacity still. And those technical effects will fade and inflation will come down because of these downward pressure. And that's why we need to continue to provide support.
Thank you. Thank you, Governor.
Thank you, Governor. That's my time. And thank you to your service through this pandemic.
We will go with one question each from Mr. St. Marie, Mr. Julian, Mr. Kelly, and Mr. Fragaskatis, and then we'll have to end. I would say, Governor, I'm sure glad we're learning from the lessons of histories. I'm one, and there may be others on this committee who faced 23% interest rates in the 1980s. And I'll tell you, we paid for that for a very, very long time. So lessons from history are a good thing. Mr. St. Marie, one question.
Oui, merci.
Thank you. If I understood you correctly, you reminded us that the monetary policy looks at the entire economy. And if you want to have any more targeted interventions, you have to look at the fiscal and budgetary policy. So there's a difference between the real economy. For example, if you look at the labor market and you look at the launching of some assets, for example, if you look at the real estate market, you really have to look at the fiscal and budgetary policy to resolve that inequality. I would like to hear your comments on that imbalance. As you said, the monetary policy is a macroeconomic tool. And it has to be managed to reflect the needs of the economy in general, as a whole. If you look at the real estate market, you can see that there is very strong demand right now. A lot of Canadians are working from home. Our children are studying at home. All of their recreational activities are at home. And Canadians want more space because they're home all the time. All of a sudden, they don't have to go to the office. And many think that even after the pandemic, there will be this opportunity to work at home. And so they are willing to move further away from downtown into suburban areas or smaller communities. And that is why you see the increase in demand. It takes time for the supply to kick in. And that's why the prices are so high. In our outlook, we think that the supply will respond and that there will be a more balanced market. But that will take time. And there are risks associated with that, especially if households think that the increased prices will continue. There is the risk that they will take on too high a mortgage. So there are measures being taken by OSFI, for example. They recently announced some changes in its 2020 guide, and it's a good idea. The guide provides for a more dynamic situation. If there is a floor required for a mortgage, that would be a good thing. If the interest rates are so low right now, there is a strong possibility that interest rates will rise, and we have to protect Canadians from that. In the federal budget, there are also a few initiatives that were proposed to increase housing supply. Thank you very much.
Mr. Julian, one fairly quick question so we can get a couple others in.
Yeah, thanks, Mr. Chair. Governor McLeod, at the beginning of this pandemic, we asked OSFI to give us an accounting of the overall level of liquidity supports provided to Canada's big banks. And they stated at the beginning of the pandemic, this was in days of the pandemic hitting, $750 billion, which is an astronomical amount, of course. So I'm interested now, you've stated that the programs that were providing support have been wrapped up. Can you give us a figure of the overall level of liquidity supports given by the Bank of Canada to the banking sector through this pandemic?
Well, as I indicated, there were 11 programs in all that provided extraordinary liquidity support. 10 of those 11 programs have been wind down or where we've announced that they will be terminated. The last ones end in May. In terms of the overall support, I mean, there's 10 programs. They each have different supports at different timings. It's hard to give you one number to summarize all this, but in fact, the committee has requested a report on the liquidities, and you will be getting that shortly. So you'll have all the numbers on all those programs.
Okay, Mr. Kelly, a fairly quick question, followed by Mr. Fragiskatis with a fairly quick question.
Well, your testimony today confirms something that was offered to the committee from an expert witness a while ago that I think was then speculative, and in saying that both the Fed and the Bank of Canada will tolerate whatever inflation occurs in 2021 as both transitory and salutary, but and that inflation would increase to 3% and likely go a little higher than that. It sounds to me like, if I understood you correctly, you say that you do expect to hit that outward bound at that 3%, come back down to 2, come up a little bit more, and then come back down. That sounds like fairly precise targeting. So I guess maybe a two-part question. How much inflation will you tolerate in 2021 and 2022 and keep interest rates where they are? And what are the factors? What are any of a number of factors that would on which this fairly precise guess about this up and down between 2 and 3% relies?
Well, first of all, I want to thank you for highlighting that there is uncertainty around these forecasts. They are forecasts, and we do our analysis. We're transparent with Canadians, but there are risks on both sides of these. I'll remind you that our band is 1 to 3. We actually had inflation was well below the band. This time last year, it was negative actually for a few months, and has been around the lower end of the band for quite a few months, around 1%. We do think it will go up temporarily, as I indicated, due to a number of technical factors, to 3 before coming back down. So one of the reasons we put out a forecast, and we are so transparent, is that so the market and Canadians can see if things are evolving the way we think they're going to evolve. So if inflation starts to go higher than we thought, and particularly if that turns out not to be temporary and it turns out to be more durable, that would suggest that the economy is tighter than we thought. There is not as much excess capacity. We would start to reassess our evaluations. You can't just look, though, at what inflation is doing. You do have to see why it is doing. When there are temporary technical factors, as your expert witness suggested, we will look through those. Monetary policy takes time to work. It doesn't make sense to overreact to temporary factors that are going to work their way out. But if we saw that inflation was sustainably higher than our forecast and sustainably higher than our target, yes, we would react, and we have the tools, and we know how to control inflation.
Okay, thank you. Last question, Peter, and fairly snappy if he could.
Thank you, Chair. Governor, thank you for being here. You shared with the committee in your remarks that you and the bank are foreseeing very robust economic growth in the year to come. But what are some key sources of potential risk, things that could stand in the way of that, things that you worry about? I know it's hard to predict that, but sources of risk I think are important.
I couldn't agree more. And as I said to the previous, look, there is a lot of uncertainty. And as I highlighted in a previous answer, look, the biggest uncertainty is the course of the pandemic itself. We're assuming, look, this is a very nasty third wave. We are not through it yet. In our base case projection, we have restrictions being lifted towards the end of May through June. if that gets extended, if there are new variants, if there's problems with vaccines, those will all have consequences for our economic outlook. Beyond the pandemic itself, there are a number of uncertainties. I highlighted in a previous answer, the U.S. economy is doing well. We do expect that we will get some positive spillover effects from that. That will boost our exports, but there are risks to our exports. We have, to be frank, we've been disappointed in the past. I think certainly if the Canadian dollar were to be materially stronger, that could undermine the competitiveness of our exports and create a new headwind for our exports. There are also some risks with respect to protectionism. The U.S. has a Buy America program. Hopefully, Canada and the U.S. can sit down and work this out so that we can have an integrated North American market. But if there were new protectionist measures that limited our access to the U.S. market, for example, that would also dampen our exports. The final thing I'll mention is, to date, corporate bankruptcies actually have been quite low. I think that has a lot to do with the various supports that have been provided, but there's no question there's lots of companies that are just hanging on. It gets back a bit to my earlier risk with respect to the pandemic. The sooner we can get through this, we can gradually reopen the economy in a safe way, and those businesses can restart, the better. But if that gets delayed, there are risks that bankruptcies could increase. So, look, there are a number of upsides. As I mentioned, there's a lot of accumulated savings. That creates some upside risks. The U.S. economy is strong, but there are downside risks, and we're certainly weighing both of those, and we will be assessing how those evolve going forward. And I look forward to coming back to the committee and updating you.
Thank you. Thank you very much, Governor, for answering all our questions. I think that last question shows what we appreciate about your leadership and the bank's leadership, and that is your frankness. And we appreciate that very much. And we do thank you for the leadership of the Bank of Canada answering our questions today. And we do hope the next time that you appear before this committee, this pandemic is behind us. We all want to see that, regardless of what political differences there might be. So thank you for appearing today, and we will have to suspend there and go to our next witness. Thank you again.
Well, thank you for having me. Good afternoon.
Meeting suspended for about 1-2 minutes. we will reconvene the meeting and we call the meeting to order. And in this panel, we are looking at the economic and fiscal outlook. And we have as witnesses from the Office of the Parliamentary Budget Office, the Parliamentary Budget Officer, Mr. Giroux, Director Fiscal Analysis, Trevor Shaw, and Senior Director Economic and Fiscal Analysis, Chris Metier. Welcome. I assume, Mr. Giroux, you have a few opening comments. I believe I've read them earlier, in fact. So the floor is yours. Go ahead, and then we'll go to questions. And the first one up on the question rounds will be Mr. Fast, followed by Mr. Fragaskatis, shared with Mr. McLeod. Floor is yours.
Merci. Merci, le Président.
Thank you, Mr. Chairman. Good afternoon, Mr. Chair and members of the committee. Good afternoon. Thank you for the invitation to appear before you today to discuss the economic and fiscal outlook. I'm also pleased to highlight some key issues arising from Budget 2021 that was tabled on April 19th. Today, I'm joined by Chris Metier and Trevor Shaw, who will help respond to your questions. We released our pre-budget outlook on March 31st. Our outlook showed a significant improvement in the economy due to the earlier than expected arrival and administration of effective vaccines, higher commodity prices, and a stronger U.S. recovery. While the most recent surge in new COVID-19 infections presents a near-term risk, the resilience and adaptability that the Canadian economy exhibited during the second wave, combined with increased vaccinations, should limit the economic impact of the third wave. Nonetheless, we will continue to closely monitor developments. Our outlook, of course, did not include the new measures that were announced in last week's budget, nor did it include the up to $100 billion in stimulus spending earmarked in the government's fall economic statement. Our outlook showed the level of nominal GDP and budgetary revenue returning to their pre-pandemic paths over the medium term. On a status quo basis, we projected the budget deficit to hit 16.5% of GDP, or $363.4 billion in 2021, and then decline to 0.7% of GDP over the medium term. The federal debt-to-GDP ratio was projected to peak at 49.8% of GDP, before gradually declining over the medium term to 45.8% of GDP. As noted in our report, uncertainty surrounding the outlook remains high. That said, setting aside the government's earmarked stimulus and Budget 2021 measures, we judged that risks to our economic and fiscal projection were roughly balanced. I will now turn to Budget 2021.
So, key issues in the Budget 2021 from our perspective. First, the fiscal guardrails. In our December report, we judged that the $70 to $100 billion earmarked in stimulus spending could be miscalibrated if the focus was solely on returning selected labor market indicators to pre-pandemic benchmarks. Given the improved labor market outlook, our pre-budget report reiterated this assessment. Based on our projection of the guardrail indicators the government identified in its fall statement, almost all of the ground lost in the labor market due to the pandemic will be made up by the end of 2021-22. To be clear, we're not referring to temporary COVID-19 measures, but rather, as the fall statement indicated, to targeted stimulus to jumpstart the economy. Moreover, measures could be fully justified based on policy objectives other than providing economic stimulus. In Budget 2021, the revision to the private sector economic outlook and fiscal developments provide $109 billion in terms of new fiscal room over 6 years. That is, before any new measures were introduced,
the budget deficit would be over $100 billion lower on a cumulative basis than forecast in the fall statement. This new fiscal room is used to finance over 3/4 of the $143 billion in measures detailed in Budget 2021. While the budget refers to all these measures as investments, $37 billion are tied to COVID-19 spending. Up to $69 billion over the next three fiscal years could be construed as stimulus spending. Budget 2021 also estimates the economic impact of $126 billion in recovery plan measures over the next 3 fiscal years. These estimates, however, likely overstate the impact of stimulus spending on the economic outlook presented in Budget 2021. The impact of $25 billion in measures from the fall statement should already be reflected in the March 2021 private sector survey. The recovery plan also includes $32 billion in additional COVID-19 support, which are not per se stimulus measures. Moreover, some of the remaining measures were anticipated by economists and would also be included in their forecasts, as the government had clearly signaled its intention to spend $70 to $100 billion in the fall statement. We will be providing our own estimate of the economic impacts of the $69 billion in Budget 2021 stimulus spending in a future report. Finally, the fiscal anchor. Budget 2021 sets out a fiscal anchor, which is reducing federal debt as a share of the economy over the medium term and unwinding COVID-19 related deficits. Over the medium term horizon, the government projects the federal debt ratio to decline marginally to 49.2% of GDP from a peak of 51.2% and remain well above its pre-pandemic level of 31.2% of GDP. Long-term projections presented in the budget also show the federal debt ratio remaining above its pre-pandemic level through 2055. This suggests that the government has decided to effectively stabilize the federal debt ratio at a higher level, potentially exhausting its fiscal room over the medium and long term. This means that any substantial new permanent spending would either lead to an increasing debt to GDP ratio or have to be financed through higher revenues or spending reductions in other areas. With that, we'll be pleased to respond to your questions.
Thank you very much, Mr. Giroux. And we were a little late starting, so I'm going to hold the subcommittee on agenda and procedure report until the next meeting, because we do have a hard stop at 6 o'clock Ottawa time. So we'll go to the 6-minute round started by Mr. Fast, followed by Mr. Fragiskatis. Ed?
Well, thank you very much, Mr. Giroux, and good to see you at committee. There are some who've suggested that we shouldn't get our knickers and not about the size of the debt because debt servicing costs are so low. However, there are some fears that the Bank of Canada rate may rise earlier than expected, perhaps sometime in 2022. Can you speak to the risk of rising interest rates? And has your office modeled what each 1% increase in rates would mean for the debt that the federal government has incurred over the last 6 years?
Thank you for your question. So yes, I've heard that very often, that it's not a concern to be had about the increasing level of debt because the current debt servicing costs are very low, which is true. But that's taking the point of view that because the cost to service that debt is low now, the debt that will have to be supported by the government over the next decades does not matter as much as it used to, which is taking the point of view, I assume, that interest rates will never rise. So we have done calculations and with what we call sensitivity analysis, and the cost of a 100 basis points shock to interest rates, so a 1 percentage point increase in interest rates, has an impact in the first year on public debt charges of increasing them by $4.5 billion. And that rises as the debt needs to be refinanced. And by year 5, the additional debt servicing costs amount to $12.8 billion per year. That's when interest rates rise by 1 percentage point.
Okay, so do you see this as being a significant risk to the sustainability of the budgetary deficits that the government is running?
It is indeed a risk, and we saw that in the government's budget. The government's budget assumed slightly higher interest rates than we have assumed, and that has led the interest cost of the government to increase by about $17 billion over a 5-year horizon compared to our own outlook for the same period. So just because the government forecasts slightly higher interest rates than we at the PBO have done, that leads to $17.7 billion, I think, over 5 years in additional debt servicing costs. And that's the same perspective, medium-term perspective. So, for example, if due to an international financial crisis, for example, or just rising interest rates because the economy is picking up speed, that could lead to additional spending on debt servicing costs alone.
Okay, thank you. Now, just to be very clear, you have said that the $100 billion plus of federal stimulus that was supposedly spent in this budget, there's a good chunk of that was actually not stimulus, correct?
Yes, indeed. That's some of it is support measures for COVID-19. So it's not stimulus per se, because when we heard the Minister of Finance in the fall economic statement, it was to be $70 to $100 billion additional to kickstart the economy, and that was understood, at least by me, to be distinct from COVID-19 support measures. But the measures that were announced in last week's budget, what the government has quoted as $101 billion in economic stimulus, also includes COVID-19 support measures, extension of previously announced measures for the most part.
And I had the same understanding as you did, that in fact, the stimulus spending wouldn't include those emergency measures. And in fact, that was all included in that $100 billion. Let me ask you, one of the finance officials on budget day suggested that all government spending is stimulus. Do you agree with that assessment?
Well, I would say most government spending leads to increased economic activity. So it's a matter of magnitude as to what the different impacts are of different government investments or spending. For example, if you're sending money or providing income support to individuals, it has a different economic impact than if you are providing economic supports that are then spent on imports. So you could say that all government spending leads to some level of economic activity, but to varying degrees, however.
Could you comment again about the rigor of the fiscal anchor that the minister chose in her budget? We're really not talking about much below 50% debt to GDP over the next 5 years. Is there anything in the budget that would signal that there's a plan to return to balance at some point in time in the future?
I haven't seen any indication to that effect in the budget. We have seen the fiscal forecast until 2025, 2026, and even over that horizon, the government shows a decreasing deficit, but still a deficit of above 1% of GDP, if my memory serves me right. So leading to a debt to GDP ratio that is barely decreasing from the peak that it's supposed to reach in the next year.
Okay, thank you both. Sorry, Ed, we are just slightly over time. Okay, we'll go to Mr. Fragas-Skatis, who will be sharing with Mr. McLeod. Peter?
Thank you, Chair. Thank you, Mr. Giroux, and to your officials for being here. I want to ask you the same question I asked Governor Macklem a few minutes ago, and that relates to growth and impediments to growth posed by risk. At the end of March, I saw that you and your office forecast that in the year, well, this year, 2021, 5.6% is what's predicted in terms of economic growth for the country. In 2022, that drops a bit to 3.7%, but still robust. And those predictions are roughly in line with where the Bank of Canada forecasts things, as we heard earlier today. My question to you is, what sources of potential risk do you see that we all need to be mindful of that could stand in the way of that strong growth?
Well, like the governor said, I will probably have the same risks identified as him. The biggest risk is by far how the pandemic evolves and the flowing from that, not only how the pandemic evolves, but also how Canadians behave. So, and I mean by that, how secure they feel to resume what will be the new normal if it is back to where we were pre-pandemic. So it will be highly dependent, the recovery will be highly dependent on Canadians' confidence that they can go about their daily lives, travel, go out, and etc., without getting sick. So a lot depends on how the pandemic evolves. Another big risk is, or uncertainty, is the level of recovery in the U.S. So if the pace of recovery in the U.S. is faster, as many expect, then it will have beneficial impacts on Canada. Another unknown is risk is a risk of faster than expected rising interest rates. So faster interest rate rises could dampen growth by weighing on households and businesses who would then have to support a higher burden of debt servicing costs and governments as well. So I could go on. There are upside risks and downside risks, but these are the main ones that come to mind.
Thank you very much. No, and I don't usually ask the same question twice. It's simply because we had the governor here today and yourself, and I think it's important to get on the record what both of you think where risk is, how both of you judge it and sources of potential risk. The fact that your answers line up almost entirely compared to one another. I mean, you virtually gave the same answer, Mr. Giroux, as Governor Macklem did, says a great deal about these factors, and they're the key things to pay attention to for us as a committee. So I appreciate it. With that, I'll turn it over to my colleague, Mr. McLeod.
Mr. McLeod.
Thank you, Mr. Chair, and thank you to the presenter today. I have two quick questions I want to ask. The first one is the IMF estimate that we would face much higher unemployment and debt costs about the same amount that has been spent due to much worsening economic scarring. Can you comment on their analysis and whether you agree with the notion that the economy would have been worse off without government intervention?
Well, it's a tough question to answer because it requires, to be certain of that answer would require running a sadistic experiment where two identical countries would be subject to very different treatments. One thing is sure, without government support, like widespread support, there would have been tremendous amounts of economic and social distress. Thinking only about all the small business owners who would have had to put the key under the mat and close down business, and let alone all these millions of individuals who would have found themselves unemployed, facing bankruptcy. So there would certainly have been a high cost of no government intervention or much smaller government intervention. But these are not only dollar costs, they would have been tremendous social costs. So that's why it's difficult to comment precisely whether it would have been worse or not that bad to have lower or no government interventions at all. It certainly would have led to a very high amount of fiscal, financial, and social distress.
My second question is regarding the National Guaranteed Basic Income. Earlier this month, your office released an analysis of the National Guaranteed Basic Income, and your office noted that because of the lack of data included in Stats Canada database and the model that was used for this analysis, the report does not show how such a potential program could affect the people in the Yukon or Northwest Territories or Nunavut. Given how different our three economies are from the rest of Canada, could you speak to how useful it would be, not only for analysis, but for policymakers and for public at large? Stats Canada were able to provide data that truly reflects the whole of Canada?
That's a very good point, sir. We often face the same issue when we are looking at policies or costings that apply nationally. When we look at the territories, the data is not as robust. And we often imply that the impacts would be broadly similar in the territories than they would be in provinces. But we all know that the realities are different, especially when it comes to social issues. And a guaranteed basic income is a very good example of a social policy that would have impact that would be very different, probably very different in the three territories than they would be in provinces such as Ontario, Quebec, Alberta, or BC, because of the very different structure and nature of the population. So in that case, it would be, especially in a case of a GBI, it would be very useful to have a solid, robust data related to the territories and its inhabitants.
Okay, thank you. Thank you all. Turning to Mr. St. Marie, followed by Mr. Julian. Gabriel, 6 minutes.
Oui, merci.
Thank you very much. Good afternoon, Mr. Giroux, and good afternoon to your colleagues who are here with you. Our Parliamentary Budget Officer. I'm a little bit reluctant to ask you specific questions on the budget that was just tabled, which is 800 pages long. I think it would be preferable to just let you and your team do the detailed analysis. But based on what you said in your opening statements, you said that you are going to announce that you are going to look at the economic impacts of the $69 billion in the budget stimulus spending. First of all, is it a good investment? You said when you were speaking with Mr. McLeod that the stimulus that was used during the pandemic did have some social consequences as well. Now we're coming out of the pandemic, we hope, and we want to find the best economy possible. So we are getting further into debt, but we're hoping that at the end of the day, it will have all been worthwhile, and it will have enabled us to maintain our economic capacity. I was wondering if you had any perspective or any ideas about this envelope of $69 billion. Well, I don't know if it's appropriate or not, but I said a few things earlier that I will reiterate. In its fall economic update, it said it would use between $70 and $100 billion to stimulate the economy, to make sure that the labor market indices would get back to their pre-pandemic levels. But what I did say on a number of occasions is that based on the lack of that type of stimulus, the predictors, including ourselves, had thought that the levels would go back to their pre-pandemic level at the end of this year or beginning 2022. And that is why I said that the amount and the timing could miscalibrate to a certain extent. It might be a little too late. Now, we want to get back to pre-pandemic employment levels. That's the first part of the answer. The second part is that we think that the economic impact of those sums may have been overestimated in last week's budget. and we will try to review that in detail in the coming weeks to see what positive economic impact these stimulus packages will have. Perhaps the government is overly optimistic when it estimates the impact it will have on employment and GDP. But we hope that we will have a better idea, and Chris and Trevor are working on that. We would have to come back later for a detailed estimate of the economic impacts of those sums. Well, thank you very much. And we are very anxious to see the results of your research on that very crucial question. Well, if you're looking at this stimulus of $69 billion, how would that compare to what other countries are doing, other industrialized countries? Since this is a debate that has raised a lot of controversy. Indeed, we did make some international comparisons before coming here today. You can't make the distinction between the COVID support measures and a stimulus package. But the two types of stimulus, say, are bound together sometimes. What the IMF said was that Canada is in 5th position when it comes to stimulus spending, compared to the 29 biggest economies. That is in terms of direct stimulus with regard to access to credit or corporate financing. Well, we don't fare quite as well. Trevor knows more about that than I do, these international comparisons, and perhaps Trevor could answer. No, I have nothing to add. Thank you. Thank you. Do I have any time left, Mr. Easter? 1 minute. All right. In your opening statement, you said that the debt to GDP ratio has increased given the expenditures, and it's gone up like 50%. And you said that in the medium term, it should be around 45%, which is nonetheless higher than the pre-pandemic level. You talked about a 1% possible increase that could have major consequences, but with current interest rates, will these debt levels lead to increased expenditures, or will they be the same as before? The investments and the expenditures announced in the budget will add to the deficit. We were looking at a percentage that might stabilize a bit lower than that. If you look at the debt to GDP ratio and the expenditures, it will go as high as 51%, and it will go down very slowly in the next 4 or 5 years. And if you look at the interest rates, mean that the deficit servicing over the next 6 years, let's say, will be about 17 or 18 billion dollars more than what we had predicted at the end of March, or in fact what the government had predicted in November. All right, thank you very much.
To both Mr. Julian, followed by Ms. Jansen. Peter?
Merci beaucoup, Monsieur le Président. Merci, Monsieur.
Thank you, Mr. Chairman. Thank you, Mr. Giroux. It's a pleasure to see you, as well as Mr. Shaw and Mr. Mathieu. You actually make an incredible team. You are doing an extremely important job. And we are very impressed by your availability to meet with this committee. Today, the office published an important report, and it was done in the context of this current pandemic. I was wondering whether you could highlight the importance of that analysis and how it dovetails with other studies that were carried out in the past few years. There's also an impact on wealth tax and the impact on tax havens that exist right now and the sums that are transferred to those tax havens. Could you possibly say a few words about these analyses that you carried out and the impact it would have on our economy? Yes, we published a report a little bit earlier today on corporate profits, and it estimates how much the Canadian government could collect in additional taxes if there was an additional tax on corporate profits, especially those companies that had better results than in previous years. We're looking at corporations that have revenues of $10 billion or more. And we looked at the results of the past 3 years. We looked at their revenue margins, and we looked at the sales and transactions for 2020 and the profits that were higher than in previous years, and see what would happen if those profits were taxed at 15%. And for 2020, that would translate into revenues of around $8 billion. This is consistent with other measures that we looked at. For example, a tax on the web giants that could generate between $2 and $3 billion, depending on the parameters used. We also looked at the tax gap over the past few years, whereby we tried to estimate how much the government would have if it collected all of the sums that would be due, and it is estimated that the government loses about $25 billion through tax evasion, tax avoidance, people who don't declare their income or who don't actually pay the sums due. So a number of measures could be taken to reduce that fiscal gap. It's not realistic to eliminate it entirely because there are some companies that do go bankrupt at the time that they're supposed to pay their taxes, so we can't recover those taxes. But it would be possible to reduce that $25 billion gap by introducing some legislative measures as well as some tax recovery programs in cooperation with CRA.
Those studies are extremely important, I think, for the public domain because we have, in my opinion, an absolutely failed fiscal policy under the previous government. Under the current government, it's even worse, and we're seeing increasingly this chasm between very, very wealthy Canadians, billionaires increasing their wealth by $78 billion during the course of this pandemic, and most Canadian families that are within $200 of an insolvency on any given month. I mean, there's this chasm now of very wealthy and an increasing number of very, very poor people in this country that's been exacerbated by the pandemic. Now, you mentioned in your comments about exhausting the fiscal room. And you have indicated in the past in committee, and you indicated again today, that there really are only two doors. One door is to slash and cut existing programs and simply remove those supports from Canadians that already are struggling to make ends meet. The other is to create new categories of taxation that actually allow the wealthy, the ultra-rich in this country to pay closer to their fair share of taxes. Could you comment on what the impact would be if we talk about the policies you mentioned, the wealth tax, the excess of profits tax, shutting down overseas tax havens, what that could mean in terms of expanding the fiscal room and allowing for investments that will actually make a difference in people's lives?
Well, it's all a matter of policy choices that the government makes or could make. So, for example, if we were to look at more aggressive tax compliance measures, either legislative or administrative policies, so actually enforcing more aggressively legislative pieces that are already on the books, that could contribute to narrowing the fiscal gap of $25 billion, which is the difference between what should be paid to the government if everybody fully complied and paid the amounts owed under legislation, and what the government actually ends up collecting. So plugging some of that gap could allow the government to either spend or reduce taxes, depending on policy choices that the government would decide to make. There's also the possibility of, as you mentioned, Mr. Julian, increasing taxes, or rather levying new taxes on corporations or individuals. But these are all policy choices. And as your humble servant, parliamentarians, it's not up for me to comment on whether ones should be implemented or not. It's for you collectively to decide as parliamentarians. But of course, additional revenues could lead to more government spending on programs or reducing other types of taxes.
Okay, thank you. Thank you both. We'll turn to Ms. Jansen, followed by Ms. Petrakis. Tamara, 5-minute round.
Thank you. Mr. Giroux, can you tell us how much permanent spending is actually in the budget?
Oh, that's a tough question. So permanent, to the extent that we have a 5-year horizon, and that's where usually the budget horizon ends, so nothing unusual. In the last year of the horizon, so it's 2025-26, I see $16.7 billion of new spending, but I will rely heavily on Chris and Trevor to correct me, because there are a lot of numbers in the budget and a lot of pages too. So as one of your colleagues alluded to, 840 pages in French, over 700 pages in English, and I glanced at every single one of them. So forgive me if I got that wrong, but I think it's $16-17 billion of permanent
Does
spending.
Trevor or Chris want to come in?
I believe in the final year, the total budget actions since the fall statement and budget 2021 were categorized at $16.1 billion.
Okay, thank you. My next question, when you reviewed the numbers, did you detect any commitment to future reasonable deficits in this budget, yes or no?
You'd have to define reasonable. So the last
Similar
year,
to in the last days, yeah.
so last year of the forecast horizon has a deficit of $30 billion, which is higher than 1%. So if your definition of reasonable is 30 and above, you're fine. If it's way below that, then it gives you an answer.
Without a commitment to a reasonable deficit reduction plan, what risk do we run of losing credibility with the international community?
Well, the risk is not immediate of losing credibility, because we're in relative good company in the league of countries who have deficits as far as the eye can see on the horizon. But it doesn't mean that it will stay like that for most G7 countries. So in the League of International Comparison, Canada is the 11th lowest for net debt in 2020 among 29 advanced economies. And it's scheduled to be the 6th lowest, but that's as things stand now. It doesn't mean that future budgets won't have additional spending measures. In fact, it's, in my opinion, very likely. So this will change, of course.
Right. Okay. So earlier, the governor of the Bank of Canada asserted that he will control inflation. Is it accurate to state conclusively that the Bank of Canada completely controls inflation simply with monetary policy? Aren't there other factors that impact inflation over which he has no control whatsoever?
You're right. There are other factors. One of them is the reason why I'm here. It's fiscal policy or budgetary policy. So the more a government spends, the more likely it is to generate inflation, or at least inflation expectations. And that's a good, the last week's budget was probably yeah, what probably made the governor's job slightly more difficult.
So would relatively small pressure from these sorts of outside influences have serious consequences for us? Yes or no?
Small, I would say no. If it's small pressures, I would say probably not a big impact.
Okay, and the Department of Finance's own numbers say we could be back within spitting distance of more historical deficit numbers as early as next fiscal year with no austerity measures necessary. So what risk does Canada face with taking on this enormous debt, considering the fact that interest rates are on the move and all signs point to rising inflation?
Well, what the government and the Department of Finance published in the budget is a worst case scenario. So what I would have liked to see in the budget is a status quo scenario, that is what the fiscal track would look like, the budget or the debt would look like without the budget interventions or the budget investments. So to respond directly to your question, the risks of higher deficits and higher debt with interest rates rising, especially if there were to be new permanent spending in future budgets or in future government decisions, is that the debt to GDP ratio could, rather than stabilize or even decline a bit, could start to rise and rise and rise, and then it would become a bit more. It would, every time you have a debt to deficit ratio that increasing, the longer you wait to stabilize it, the more difficult it is to course correct. So that's the risk.
Okay, thank you. We'll end that there. We'll go to 5 minutes split between Ms. Katrakis and Ms. Zerowitz, and I'm told by the clerk we can go a little past 6, so we can probably go to Mr. St. Marie for 1, Mr. Julian for 1, Mr. Falk for 1, and Mr. Fraser for 1. So, Ms. Katrakis.
Merci, Monsieur le Président. Merci, Monsieur Giroux.
Thank you, Mr. Chairman. Thank you, Mr. Giroux, for coming to see us this afternoon. It's always a pleasure to see you. We know that economic growth is the best way to deal with the increase of a debt post-crisis. Do you think that the government's response throughout the pandemic, as well as the measures announced in the budget, will be effective to manage the economic growth to deal with this debt? Thank you very much. As a non-partisan federal officer, it's very difficult for me to answer that question. My team and I will certainly look at the economic impact of the measures that were announced in the budget. In other words, what the impacts will be on economic growth, as well as employment levels. But it's not up to me to determine whether the measures are appropriate or not from a public policy perspective. They are obviously political choices. If you ask different people, you'll get different opinions on the best way to generate economic growth. So it is a question that I unfortunately cannot answer. So it's quite a tricky question that I asked. Yes, indeed, you were able to pick a very tricky question for me. Thank you very much for your answer.
For 2021 of $354 billion is approximately $16 billion lower than what was forecast in the fall economic statement. What do you attribute this improvement?
It's mostly due to better than expected economic activity. So what we call economic development. So stronger economic activity, stronger labor market than expected in the fall. And so that's the gist of the improvement. There's also some lower cost than what was expected for some COVID-related measures. And off the top of my head, I don't remember exactly which ones came in lower than expected, but I think it is the wage subsidy, but I'm not totally sure. Trevor and Chris can complement that.
Certainly, Eve's absolutely right that a very important part of the reason why Finance Canada's projected deficit is coming in lower in 2020, 2021 prior to measures is because of the story on income taxes. So the economy is doing better than they previously forecast, and that leads to higher taxes. One other aspect on the spending side to take into account is that the government forecasts to spend less on its operations, in part because higher interest rates that were previously forecast mean that anticipated pension and current service costs for pension benefits will be lower. And so that in turn leads to lower operating expenses. And those are two very important factors for why Finance Canada's estimates have come in with a lower deficit projection for 2020-21 than in the fall economic statement.
Okay, Ms. Zerwitz.
Thank you so much, Mr. Chair. And thank you, Mr. Giroux, for the important role that you play in our nation. We've been talking about budget 2021, and we know it's a huge spend budget. It's the first budget that we've put out in 2 years. Today, Canada has been reaffirmed by S&P Global with a AAA credit rating. How is this reaffirmation a signal that Canada is on the right path to recovery?
Well, it's the assessment of one very important credit rating agency, and it also is a signal that at least some actors in the financial markets have confidence in the solidity and credit worthiness of Government of Canada bonds. So in that sense, it's good news for governments in Canada, not just the federal government, but also provincial and local governments, because a downgrade would have had potentially repercussions throughout federal, provincial, and municipal finances. So in that sense, it's good news. It means that interest rates or the cost of borrowing for these levels of government will not unduly go up. It will go up if interest rates rise, but there won't be a premium to be paid because of a potential downgrades.
Okay, we will have to move on. I'm sorry, Julie. We'll go to St. Marie for one question and Mr. Julian for one question.
Oui, dans quelle mesure est-ce qu'on...
Thank you. To what extent should we be concerned about the increased housing prices and the household debt in relation to the economy? It's a major risk factor in our economic scenarios and our economic outlook, because the increased housing prices are such that people who want to buy a house have to take on more debt. And so they get more exposed to a potential increase in interest rates. And this is part of a trend where Canadians are quite in debt. Governments have debt, businesses as well. So it exposes the real economy to increased interest rates. And as housing prices go up, the greater the risk of a housing bubble. And what happens in that case is that it can burst. You saw what happened in 2008 with the housing bubble being burst. I don't think we've reached that point, but seeing how difficult it is to buy a house, that sends a negative signal, especially with regard to the increased potential of housing prices.
Thank you both. Mr. Julian will be followed by Mr. Falk, and we'll have about 4 minutes for you, Mr. Falk. Mr. Julian.
Merci beaucoup, Monsieur le Président. Et Monsieur
Thank you, Mr. Chairman. Mr. Giroux? Earlier on, you talked about measures that could be taken to deal with the web giants. You talked about $3 billion, but you're not talking about the huge profits that the web giants have been able to get during the pandemic. I was wondering what tools you would need so that excessive profits from a given sector that does not necessarily give the specific figures with regard to their sales and revenues. Answer, well, to do that, obviously, we need to have comparable statistics. We have to have historical data to see what constitutes a reasonable profit and what the definition of reasonable is. When there are few players as you find in social networks or IT, when you have some dominant players, it's difficult to have comparables between businesses that we can use to determine what a reasonable profit would be. Without having that, we can look at the return on investments that investors usually expect. But it is difficult to use just that because it doesn't take into account the risk that is associated with very specific sectors. So we have to have data on the sales, revenues, and on a historical basis. That's the easiest way to determine what is a normal profit on a historical basis and how there can be deviation or upward deviation that could then be called an excessive profit.
Thank you both. We'll turn to Mr. Falk for 4 minutes and Mr. Fraser for the last 4, and then we'll close it off. Ted?
Thank you, Mr. Chairman, and thank you to Mr. Giroux and your associates there. We've seen significant increases in the cost of everything this last year. Food has gone up. Real estate has gone up 20 to 100%, depending what area of the country you live in. Crude oil has seen a 300% increase this last year. Wood products like OSB have seen a 500% increase. We know that we're right around the corner from seeing significant inflation. With that, there's going to be higher interest rates. How rate sensitive, and I think you've partially addressed it with the $17 billion answer, but how rate sensitive is our federal debt?
That's a very good question, and that's a question that gets asked to me and my colleagues quite regularly. And we have determined that a 1% or 1 point of percentage, so 100 basis points. So if, for example, an interest rate goes from 1 to 2%, we call that a 100 basis points increase. So public debt charges following such a shock of 1 percentage point, federal debt charges go up by $4.5 billion in the first year, and they rise to $12.8 billion additional by year 5 if that one-time shock is sustained throughout the period. So as the government refinances itself, its financing costs go up by $12.8 billion by year 5 for a one-time shock of 1 percentage point.
Is all of our federal debt rate sensitive, or is it? I mean, is it all in a term and only sensitive to renewal dates, or is it also in a variable market sensitive plan?
I think they're all. There might be some very specific debt instruments that have a floating rate, but I'm not aware that there are such instruments. There's real return bonds, but they tend to form a very small portion of the overall market debt. So market debt is sensitive to interest rates as it gets renewed, but with treasury bonds that are 30 days, some are 90 days and 180 days, plus bonds that have 1, 2, 5, 10, and 30 years, there's an ongoing turnover or churn of market debt. So the moment interest rates rise, there is debt that needs to be refinanced.
Okay. The Liberal government, and you've stated so in your presentation, that they've got a fiscal anchor, and that fiscal anchor is reducing federal debt. To me, that's not a fiscal anchor. It's a wish list. And they haven't attached any hard stops to that. They haven't said that at 51.2% debt to GDP, that's a hard stop. We will not exceed that. They've used it as a goal, or I would liken it actually more to the guardrail terminology that they've been using. But the debt to GDP is only one of the markers. You know, in all my years as a banker and as a businessman, if I fixated on only one ratio, I wouldn't do a service to the application or to the business. There's multiple ratios you have to look at, and I think the government needs to establish a variety of anchors. Are there other anchors that you, as the PBO, are considering should be looked at and considered by this government?
Well, that's a very good question. And I think because there's only one taxpayer that supports all levels of government debt, I think it would be useful for parliamentarians and Canadians to look at government debt as an integrated debt. So there's federal debt that we focus on today, and that's normal. We're federal parliamentarians or servants to parliamentarians, but there's also provincial debt. And I think it would be advisable for the government and governments in this country to look at the overall government debt burden, because provincial debt is also of concern, especially in several jurisdictions that are on a path to ever increasing debt to GDP
Right.
ratio.
And we've been talking mostly about one side of the ledger, which is the debt side and the expenditure side. But how about the revenue side? Are you confident that our revenues are going to be remaining consistent, or is there a potential that we're going to see a hiccup on the revenue side?
I'm relatively confident in the robustness of the revenue numbers, because the revenue, the tax base of the government tends to be fairly reliable. It's mostly personal and corporate income taxes, as well as the GST. And these are usually well-established tax bases in Canada. So I don't have any major concerns with respect to the revenue projections. They are very closely tied to GDP. So not an area of concern that revenues could dip.
All right, thank you both, and about 4 minutes, Mr. Fraser, and then we will actually deal with the report from the subcommittee. We'll have 10 minutes following the last question. Mr. Fraser.
Excellent. Thank you, Chair. Thank you to the Parliamentary Budget Officer for being with us today. I want to pick up just where my colleague, Ms. Zarowitz, left off with the recent reports of certain credit rating agencies. We've seen S&P reaffirm the AAA rating about a month ago, roughly. DBRS Morningstar made the same decision. You've seen commentary from some of the credit rating agencies about the fundamental underpinnings of the economy being strong, in part due to the substantial and timely release of economic supports for households and businesses at the outset of the pandemic. The IMF, and if you can follow the bouncing ball with me, I hope you can stay with these various reports. The IMF tabled a report also a little more than a month ago, indicating that had those same measures that the credit rating agencies spoke of, had they not been advanced, the deficit would have been roughly the same as it is today, as a result of lost economic activity, businesses shutting down, people not working. It makes sense to me. I'm curious if you would agree with the IMF's conclusion, not only in that the scale of the deficit would have been the same without those measures in place, but also their supplementary conclusion that the economic scarring that would have fell upon the Canadian economy would have left us far worse off in terms of our ability to rebound from this pandemic once the economic recession comes to an end.
So it's an interesting question. I don't know if I can say I agree with the IMF that without any of these support measures, the deficit would have been roughly similar to what it was for in 2020-21. I haven't done the math. I haven't looked at that because, as I said before, to me, it would have been very sadistic to inflict that type of pain on Canadians. So maybe they're right. Personally, I doubt the deficit would have been the same or roughly the same in 2020-21. But there would have been clearly a scarring effect. So maybe over a 5 or 10 year period, deficits would be roughly similar, but I don't know for sure. So I wouldn't say, yes, the IMF is totally right and I agree with them 100%. But what is clear is that there would have been unprecedented scarring of the Canadian economy, the labor markets. And as I said before, the social impacts would have been like catastrophic, even worse than what we have seen due to the loss of life during the pandemic.
And look, it really was your testimony during your last appearance that provoked this question. Is it possible for you to conduct an analysis to get an answer to that question as to whether or to what extent you would agree with the IMF's assessment?
I will certainly take that under advisement. We have a lot on our plate, and as one of your colleagues mentioned, we have limited resources, so we'll see what we can do.
Okay, and Mr. Chair, have I got any time left?
You've got 1 minute.
Well, look, I'll make it quick then. One of the pieces of testimony you gave today, Mr. Giroux, was just about Canada's position in terms of its deficit or debt in comparison to its international counterparts. It struck me as that we were maybe a little better than middle of the pack right now. Is that a fair assessment as insofar as it impacts our overall debt and our debt to GDP ratio?
Yeah, I would say 11th out of 29 is slightly better than middle of the pack. Yes, that's a fair assessment.
And what that was the total national debt?
Yeah, that's overall net debt, so net debt. But the IMF also includes assets of public pension plans such as CPP and QPP, which offsets some of the other levels of debt because most other countries don't have assets to pay for future benefits. So in that sense, Canada is in a privileged position.
And then with respect to our debt to GDP ratio with the same group, where do we sit?
I'd say it's what I was referring to, 11th out of 29.
Okay, thank you so much.
Yes, and you slid in a little more than one question there, Mr. Fraser. Look, we've had a lot of good questions and a lot of good information put out here, gentlemen. Thank you very much for your work. And I think I used to look forward more to your reports when I was in opposition than on the government side. But I do think we all as MPs, as soon as you table a report from the PBO, we all go to it to see what it states. So I want to not just thank the three of you, but also thank your teams for the analysis that they do. We appreciate that, and it gives us a good information of which to raise further questions. So thank you very much for your presentation. Turning to the committee, we can release you folks now. We do have 10 more minutes. So you do have the subcommittee report that was sent to you by the clerk. And I'll table that now. I'll not read it all. I'll just highlight it. It's before you. The subcommittee met on Monday evening, and we agreed to invite on Tuesday, May 4th, re-invite again Dr. Paul Kershaw from Generation Squeeze, as well as a witness from CMHC and two additional witnesses, one from the governing party. I'll not read Mr. Julian's motion, but we agreed to basically continue the study on tax evasion and pull forward the evidence from the previous Parliament on the tax evasion study for the benefit of the committee. And we would meet on May 6th on that issue and invite 6 witnesses for that panel and possibly further panels. We agreed to call another subcommittee meeting within a couple of weeks. If the Budget Implementation Act is presented in the House, the committee commence a pre-study of the Act on May 11th and 13th, and that the minister be invited as well as senior officials. That the committee continue its study on the Budget Implementation Act during the week of May 17th with witnesses, although it says public here, both from the government and the public. If we're not done with the government witnesses, that means your constituency week is, I'm sorry to say, gone by the wayside. And that the analysts work with the chair and the clerk to provide the committee with a summary of the recommendations in regard to our study on COVID-19 spending programs and related monetary policy for an eventual report to the House. So that's what the subcommittee agreed to. Could we have somebody move that report, and then we'll get into a discussion on it if necessary. Moved by Peter Julian. Is there any discussion or questions? Julie, I think, yeah. Julie, Ms. Zerwitz.
Thank you so much. Thank you, Mr. Chair. And I just want to say a huge thanks to the committee for putting forward this report. It's always a lot more time than any one of us ever imagines. I just wanted to just put on the record how disappointed I am that after the OECD and the Canadian Chamber of Commerce and the Council of Chief Executives and I believe even the current leader of the Conservatives in his leadership platform put forward that interprovincial trade barriers is an urgent priority for us to deal with, that's not on the agenda. I think we spend a lot of time during our meetings, and today was no exception, where we talk about how do we sort of gain more revenues? How is it that we can deal with some of the structural deficiencies in our economy? And this is absolutely one of the key ways for us to be able to do so. And it wasn't seen as an urgent priority for the group. So I just want to express my disappointment. That's not to say that we're not studying important things, but I do want to express my disappointment that we're not moving forward urgently on a matter that I think needs to be looked at immediately now so that we can start putting things into place. So I think with that, those are my comments, Mr. Chair.
Okay, thank you. You're not moving an amendment, I take it, but you'd be much more pleased if that was included in the report. Is there any other discussion? Then all those in favor? Opposed? Carried. So we will go forward with that, and we will plan another subcommittee steering committee meeting as soon as possible in a couple of weeks. All right, thank you all, and thank you, Mr. Clerk, for gaining us the extra few minutes to have an hour with the PBO and get this subcommittee report done. Thank you all. Have a good evening.
Bye.
Meeting
Thanks,
adjourned.
Chair. Good to see you, folks.
Bye.
Bye.
Thank you.